Hello, this is Asa Graves, Partner and Chief Investment Officer at Graves Light Lenhart Wealth Management. This update will review quarterly market returns as well as several key economic and macro trends. Importantly, the focus of this update is on our current asset positioning and how pronounced variances in valuation and economic signals are shaping our views of both investment opportunities and risk management. Inflation has been an important economic topic for several years now, as COVID-era stimulus and supply chain disruptions preceded substantial inflationary pressures. The worst of these pressures appear behind us, but as we have warned for some time, the reversion back to the Fed's 2% target is taking longer than many hoped. June CPI cooled to 3% year over year and has declined significantly from the peak of almost 9% in 2022. While CPI provides a consistent historical benchmark for inflation, the Federal Reserve more closely watches changes in the Personal Consumption Expenditures, or PCE, price index, which is based upon a different mix of consumption measures. The most recent PCE index release for May indicated that inflation is currently running about 2.6% year over year. While the deceleration in both inflation measures is encouraging, the post-COVID inflation experience has been volatile, as shown by the chart on the right. The blue columns represent the average PCE rate for each specific monthly range, with the dark blue column showing a meaningful increase or acceleration in inflation in subsequent months. Our message remains that while we are encouraged by the weakening of inflationary pressures, we remain mindful of the stickiness of inflation and the associated security market risk inherent in the current investor exuberance, which has pushed up securities prices in expectation of a quick reversion back to the Fed's 2% target and the resumption of a much lower interest rate environment. The post-COVID economy has been primarily one of very strong economic growth, outside of a significant stutter in late 2021 and early 2022. However, economic growth so far in 2024 has been off its highest levels and is tracking around the long-term U.S. average of about 2 to 2.5%. The current Atlanta Fed GDP Now estimate for second quarter growth is 2%. Such softness is not uncommon. After all, below-average growth happens in about half of all quarters. The real question becomes whether this weakening in economic growth will continue or rebound to higher levels. The unemployment rate for June increased slightly to 4.1%, up from 4% in May and 3.7% at the beginning of the year, reflecting the trend of modest economic weakening. But similar to the discussion around GDP, a 4.1% unemployment rate is solid on a historical basis. If the Federal Reserve maintains tighter monetary policy, implemented through higher interest rates to combat inflation, the risk certainly exists that the economy could weaken further. This is the dance of the Federal Reserve. Strong economic growth risks spurring inflation higher, which the Federal Reserve is obligated to prevent happening. Yet the Federal Reserve is also mandated to maintain low unemployment that is a byproduct of strong economic growth. If unemployment continues higher, the Federal Reserve would likely be prompted to cut interest rates to spur the economy. The lower that inflation moves between now and that potential need to act, the greater the room they will have to pursue interest rate cuts. This is because stronger economic growth is, again, inflationary. This economic growth-inflation tension is always at the heart of Federal Reserve decisions. Since lower interest rates tend to buoy asset prices, all else equal, the future path of these economic variables will have important portfolio management implications. The June quarter may be best described as the financial asset equivalent of a tale of two cities. Market segment returns were relatively closely grouped for the first 2 months of the quarter. However, enthusiasm for artificial intelligence-related prospects for large tech stocks drove an overall quarterly gain of 9.6% for the S&P 500 Growth Index, with 7% of the gain occurring during the month of June alone, as shown in the far right column. As such, the superlative performance of the growth side of the S&P 500 drove the S&P 500 index to a 4.3% return during the June quarter. In contrast, the remainder of the equity universe experienced flat to down results during the second quarter, with large value down 2.1%, S&P 400 mid-cap down 3.4%, the S&P 600 small cap index down 3.1%, and the developed international EFA index essentially flat. In essence, 7 large stocks are driving the performance of the S&P 500, which in turn has become divorced from the trends experienced by much of the overall equity market. Moving on to fixed income, the bond market, as measured by the Bloomberg Barclays Aggregate Bond Index, basically broke even during the quarter, including both changes in the principal value and the income received, as inflation reports deflated hopes for lower interest rates during the previous quarter. Nonetheless, we continue to find the overall fixed income universe attractive on a multi-year basis. The S&P 500 has a long history as the primary benchmark of the U.S. equity market, and rightly so. Yet the current composition of the S&P 500 has become less diversified, with Microsoft, Apple, and Nvidia each accounting for 7% or more of the entire index. As such, 3 stocks now account for more than 21% of the S&P 500. Furthermore, the top 10 largest stocks in the S&P 500 now account for more than 38% of the market weight of the entire index, as shown on the chart on the left. As a result, the S&P 500 is much more concentrated and less representative of the broader U.S. stock market. To put a finer point on this dynamic, the chart on the right shows the performance of the S&P 500 starting at the beginning of 2024 through June 30th of this year. Over the first half of 2024, the S&P 500 was up 15%, while the S&P 500, excluding the Magnificent 7 stocks, gained a pedestrian 4%. Simply excluding Nvidia would have resulted in the remaining 499 stocks rising 10%. Our portfolio positioning remains focused on diversified exposure to more attractively valued areas of the overall equity market to help provide attractive long-term returns and help mitigate building economic and conflict-related risks around the world. In the long run, the underlying earnings of publicly traded companies are the key driver of future stock price appreciation. As shown on the chart on the left, the green line shows the proportional share of S&P 500 earnings generated by the top 10 companies. While erratic, the percent share has generally been in the 15-20% range of earnings generated, with the current reading at the top end of the range. The blue line reflects the percentage share of total S&P 500 market cap for those top 10 companies over time. The market cap provides a good gauge as to the value perceived by investors for these companies. Alarmingly, the implied value of the top 10 companies, mostly information technology and communication services companies, has become deeply uncoupled from the proportional economic value provided by these businesses, which may result in significant price risk if those expectations are not met, as happened following the popping of the 2000 tech bubble. Moreover, as shown on the chart on the right, there is no evidence that suggests that these businesses are immune from recession-induced earnings decline, as forward earnings within the information technology and communication services sector has been anything but a straight line historically. During every cycle, certain investors become convinced that demand for the next great thing is so great that spending plans will be immune from economic conditions. That has not been the case in the past. The inventor of modern portfolio theory, Harry Markowitz, is credited with the famous quote, "Diversification is the only free lunch in investing." Often when only one part of the investable market seems to be working, investors will often say to themselves, why bother investing in anything else? Or said differently, you know you are diversified when you hate the part of your portfolio which hasn't kept up with the recent market darlings. The illustration on this page, also called a performance quilt, provides a helpful answer. The quilt shows asset class returns since 2009 across a broad array of asset classes. As you can see, there is limited insight provided for forward year returns based on the results for any prior calendar year. While investment outcomes are invariably uncertain, diversification has proven to be the time-tested way to provide an appropriate risk management framework for investors and, by extension, the gateway to capture favorable risk-adjusted returns over the long haul. In past presentations, we have discussed the importance of monitoring the P/E ratio of stocks, which is the price divided by earnings, as it is a measure of the valuation of equities. Effectively, it is a measure of how much a new investor would be paying to buy $1 of earnings for the stock. The mean PE ratio in the U.S. market is currently quite high, which is arguably the biggest current challenge in the market. High PE ratios can be reflective of the bidding up of stock prices in anticipation of future earnings increases, in a sense pulling forward price gains that would have taken place in the future and applying them to the stock today, mitigating future appreciation potential. The academic literature contains extensive research on a particular PE ratio known as the cyclically adjusted PE ratio, or by the acronym CAPE, C-A-P-E, and finds that high CAPE ratios tend to be associated with lower future returns, consistent with this effect. This effect only plays out, however, over a relatively long run. Historically, when CAPE reaches the mid-30s, which is where it stands currently, forward multi-year returns have been less favorable relative to history for the S&P 500. However, if we narrow the time horizon to rolling 5-year forward returns, as we see in the top chart on this slide, outcomes have seldomly been positive over this entire 5-year time frame. While we do not profess expertise on timing, the absolute level of valuations in U.S. large cap stocks continues to warrant great caution. In comparison, international stocks, as represented by the EFA index, carry a current valuation which suggests annualized returns of more than 10% over the next 5 years. Of course, nothing is certain with security price forecasts, but we believe equity opportunities outside the S&P 500 index are much more likely to help clients reach their future financial goals. The fear of missing out is a powerful impulse, especially with financial assets. Not owning popular stocks which have enjoyed eye-popping performance often causes investors to chase returns and rationalize the purchase to own the long-term winners. As with most things in life, discipline provides the key to long-term success. Stock price volatility can be your friend if you maintain your objectivity and have the confidence to make desired purchases during price declines. For example, the chart on the left shows Amazon's price history from the beginning of 1999, which was prior to the March 2000 market peak, through 2002. Patient investors had the ability to purchase shares in this long-term winner at significantly lower prices once the buying panic broke. Conversely, the chart on the right shows the price performance of Zoom Video, the popular internet conference platform, from the beginning of 2020, which is before anyone had heard of COVID, through present day. Zoom experienced gains of roughly 700% during the onset of COVID through the release of promising COVID vaccine results in November 2020. While investors at the time believed that Zoom would remain the dominant long-term winner due to work-from-home trends, the stock has fallen roughly 90% from its peak, and investors fortunate to own shares at the beginning of 2020 would be sitting on losses of approximately 15% at present. The moral of the story is best summarized by Warren Buffett's quip, "Price is what you pay, value is what you get." Essentially, Mr. Buffett is cautioning that overpaying today reduces future price potential. The performance of small cap stocks has been disappointing. Small caps were performing well and outperforming the S&P 500 prior to the Silicon Valley Bank failure in late March 2023. Since that point, small caps have meaningfully lagged the strong performance of the S&P 500. Enthusiasm for artificial intelligence has certainly been a factor of the relative performance variance, in addition to a range of contributing concerns such as real estate stress and fear of future weak economic conditions. Going forward, small caps look to be more attractive on both a valuation and earnings growth basis. The chart on the left shows the year-over-year EPS growth of the S&P 600 Small Cap Index, represented by the dark blue columns, versus the S&P 500, denoted by the light blue columns. The red arrows highlight superior small cap EPS growth starting in the current quarter, with September end, through next year. Lower valuation and higher EPS growth has been a winning recipe in the past. In terms of the possibility of weak future economic growth, it is important to point out that small caps have outperformed during certain recessions and the ensuing rebound in the past. In summary, we believe the current fundamentals of small caps provide a much better value with the potential to weather future uncertainties better than large cap stocks currently in favor. We continue to be constructive on fixed income as an investment class, with bond yield levels now being attractive for both income and diversification purposes, particularly if we continue to see inflationary risk stabilize or even subside. We have shown in previous missives that bonds are better positioned to absorb higher interest rates if inflation remains sticky. The chart on the page shows the starting yield for the Bloomberg U.S. Aggregate Index, which is a key index for U.S. investment-grade bonds, on the horizontal axis since 1976. The vertical axis is the subsequent 5-year annualized return for this index. What's revealed is a reasonably tight relationship between medium-term returns and the starting yield. As of June end, the implied yield for the Bloomberg U.S. Aggregate Index was slightly above 5% annualized over the next 5 years. Thank you for your time and interest. We hope you found this information useful and that you are more comfortable with the positioning of your financial assets. As always, please let us know if you wish to discuss these or any other issues. We're here to help.